Hi, everyone. Welcome to our online series today, The Anatomy of a Private Equity Secondaries Deal. Want to give a really special thanks to our sponsor for today's session, Voya Investment Management. Before we begin, I want to give a couple programming notes for the CFA Society Atlanta. On November 4th from 12 to 1 p.m., we have another online series called the Semi-Transparent Active ETF Market. Hopefully you all can attend that. On November 10th from 5:30 to 8:30, we have our annual conferment dinner. And then lastly, on November 17th from 11:30 to 12:30, we have another online series called Boom, Bust, or Fizzle, How Investors Should Think About SPACs. So hopefully you all can attend any of those upcoming sessions. We're joined today by Alex Gerson, who is a principal with Pomona Capital and focuses on investment analysis. We have Adam as well from Pomona. He's a manager, fund evaluation reporting at Pomona. And we have Bob Alderman, who is a representative from Voya Investments Distributor, which is the distributor for the Pomona Investment Fund. Bob assists the Pomona team as Voya's head of business development for that Pomona Investment Fund. Just a quick housekeeping note, if you do have questions, please submit them via the Q&A feature within the Zoom controls at the bottom of your screen. I know Bob, Adam, and Alex will take questions probably towards the end of their session. And with that, Bob, I'll turn it over to you. Thanks so much.
Thank you, Charlie, and good morning, good afternoon to all of you. Welcome to today's webinar. It's really a pleasure for us to be here. We like talking to CFA societies across the country. You folks in the audience tend to be more inquisitive and more interested than some of the other audiences we speak to. So delighted to be here to talk a little bit about the anatomy of a private equity secondaries deal, from sourcing to underwriting to portfolio construction. As Charlie had mentioned, I head up private equity business development for Voya Investment Management, and I'll talk in a minute about the relationship between Voya and Pomona in just a minute. But we're really focused on a very timely, what we think is a very timely and interesting topic today, and are very fortunate to have the two investment professionals, which Charlie introduced from Pomona Capital, to join us. Alex Gerson, as Charlie mentioned, is a member of the Pomona Capital investment team, a key person in sourcing and doing due diligence, underwriting, investment opportunities that we look at on a regular basis. And Adam Konopolsky, who is the manager of fund evaluation and reporting for the Pomona Investment Fund, which is a 1940 and a 1933 Act registered fund that's managed by Pomona Capital. So through a panel-like discussion, we're going to focus on how private equity secondaries are brought to market, from sourcing to due diligence and underwriting to portfolio construction. Unlike most presentations, which I think focus on portfolio composition and performance, we'll be looking at what it takes to build a solid private equity portfolio. Throughout the presentation, we will be making references and using Pomona Capital as an example of what we feel are some best industry practices. Alex will be focusing on how a private equity investment opportunity in the secondary market is sourced, along with a discussion on due diligence and our underwriting process. Adam will then talk about some of the decisions that go into constructing a core private equity secondaries portfolio. Most importantly, as Charlie mentioned, we will be leaving time at the end of our prepared remarks to answer any questions or feedback which you might have. So first, a few words about Pomona Capital. Since I've mentioned the relationship with Voya, I thought it might be helpful for those of you in the audience to get a feel for what that's all about. Pomona was actually founded 27 years ago, back in 1994, when private equity secondaries were in their infancy, if you will. Not a whole lot of private equity buyers back then, but we recognized an opportunity in the marketplace to be a participant and a player in the private equity secondaries market. We are based in New York with offices in London and Hong Kong. And I think what's most important about what you see on this page is that we really are one firm, one process. We have one investment committee that makes decisions, whether it be for our 40 Act vehicle or whether it be for our institutional partnerships, which we have one in the market right now. But that same investment team is doing its underwriting and doing its due diligence. And if it's good enough for one side, whether it be the institutional or the individual Pomona investment fund, it will be good enough for both. So again, very important that that it's understood that what we do when we do our due diligence really covers all bases. So with that, just a couple of quick points on Pomona and what our main focus is. We have been secondaries buyers in the private equity space since our beginning. We're actually now well over 14 billion in program assets since our inception. And again, you know, we do some primaries and we do some co-invest or direct investing alongside of GPs who may be looking for direct investment partners. And we also manage a rather large separate account business for Voya's general account. So we do see primaries in the marketplace as well. So again, our sweet spot, if you will, is the secondary market. We do some primary and we do some co-invest as well. So with that, let's get going into the conversation with Alex and with Adam. And I'll start with Alex. Alex, when we are constructing a portfolio of choice and we think about deal sourcing, due diligence, and the underwriting process, what are some of the high-level things we look for as you begin the evaluation process?
Yeah, sure. Thanks, Bob. So, we're really from kind of the beginning looking to cast as broad of a net as possible, right? You want to see everything that's going on in the market. You want to understand where the opportunities are, and that's how you can kind of winnow down, where you're going to kind of focus. So understanding, casting that broad net, understanding what's out there, and then kind of quickly narrow it to exactly where you have an edge. So, it's been quite busy in the market this year. Banks, brokers in our space think there's going to be over 110 billion of volume that's going to trade this year in the secondaries PE market. And no firm has the resources to waste time working on everything. So, luckily at Pomona, given the size that we are, if we do call it 1 to 2% of the deal flow that we see, that's enough to deploy our funds. And so we can be very, very selective. So once we cast that broad net, it's looking for what specifically, kind of checks our boxes for deal flow that we're looking for that kind of fits with our specific strategy. So, to speak to that for a moment, we're taking a tactical approach. We want to find these situations where there's, maybe there's some valuation arbitrage. PE managers value their own assets until they're sold. And so you can look at assets, understand how they're valued versus comps, public comps, or other private comps that we know of. And we can look and say, look, this manager is valuing these companies, 3 turns below where it should be. And that's a situation you'd love to go and, buy exposure to that fund. We also look for situations where, there's a genuine sourcing advantage. It's great when you can be the only party talking to a seller, but at least, maybe one of only a few that's talking to them that can buy their assets. We're looking to use our proprietary data and the information that we have access to that not everyone does have access to. These are private assets. If you're not an investor in those assets or funds, you don't get the information. So how do we use that advantage to drive our deal sourcing and find really interesting opportunities? Basically what it boils down to, we're basically, we want to know more about the asset than the seller, ideally, and certainly than the other competitors that may be looking at a deal. And so, to do that, we're finding our edge, we're leaning in. Our investors have a lot of options for who to give money to. And so you have to find what differentiates you and our ability to source and execute on interesting deal flow That's really an important component to answering that question.
Great. You mentioned the growth of the secondary market, and I might remind folks that although the secondary market is growing as the numerator, if you will, the denominator, which is total private equity, is growing as well. So, you mentioned 110 billion. How has the secondary market really grown over the last few years? And I think many investors might be interested in what we observed during 2020 as a result of COVID.
Yeah, it's been an amazing, growth over the past decade in our market. So I joined Pomona in 2014, and back, 7-8 years ago, the total market was about 25 to 30 billion of secondaries traded, and this year it's going to be around 110 billion. So just really, extreme growth. How did that happen? Kind of the most important question. First, it's a function of the overall PE market. So you can see on the slide, just in general, private equity has raised a lot of money. And, when PE raises trillions of dollars, that becomes unrealized NAV out in the market. And what we're trying to do on the secondaries market is go out and buy, LP interests or other ways to access that NAV that's out there that we can buy into. So as that, basically as that denominator grows, as there's more and more NAV of private equity out there, there's a pretty consistent percentage of turnover every year of LPs that want to sell out of their private equity interests. So that just grows the size of our secondaries market with it. So that's, number one. Number two, we're adding additional deal types. So, we're not just buying LP interests anymore. There's also these GP-led deals where, the manager of a fund, the GP, will actually sell a company to a continuation fund or multiple assets to a continuation fund. So kind of getting creative and adding more deal types that we can use our secondaries capital to do. That's another reason why the market has expanded. And then, there's really no stigma to selling anymore. Whether it's an LP that wants to clean up their book and just be a little more active about their portfolio management, or a general partner that wants to wrap up a fund, an old fund, or they want to do this continuation vehicle idea. There's really no stigma anymore. In the earlier days, if you were selling PE, people thought there was something wrong with you, like you needed money or something. And that's not really a thing anymore. And then just to speak to the second part of that question, COVID was a really interesting experience. The market downturn was really quick, and then it bounced back really quick. And so we were able to act quickly and capitalize on a few distressed sellers that needed cash in that month or two period where the markets were really in turmoil. We got really interesting big discounts on high quality buyout, which is what we kind of stick to. Usually kind of high net worth individuals, but that was relatively quick. And then basically the markets all kind of bounced back, including private equity valuations. And so foundations, pensions, endowments, they kind of made it through that first issue without having to sell. But then they found themselves pretty quickly enough in a situation where maybe they're over allocated to PE because the performance was so good in, Q2, Q3 of 2020 and Q4 really, that the growth kind of outpaced growth of their other asset classes, and all of a sudden they're over allocated and need to sell some private equity. So it was an interesting year, kept us quite busy. We deployed personally, at Pomona, hundreds of millions of dollars last year, and just interesting to kind of track. You would have thought that the distressed sellers, there'd be more of them, but pretty quickly turned to kind of an over allocation issue in our market.
Yeah, that's interesting. And maybe it would be a good opportunity just to take a step back for those that may not be familiar with private equity, or for that matter, the secondary market. I think it's worth, re-emphasizing that the secondary market in private equity is a very inefficient market. If you do your work, you can find ways to make money, but there are lots of anomalies and lots of things that Alex and our entire investment team discover in the secondary market. So, with that kind of leads me to my next question, Alex, which is, if we drill down a little bit, why would a general partner or a limited partner, why would a GP bother to partner up with a secondary buyer? And how does Pomona keep its finger on the pulse of the funds that it wants to purchase?
Yeah, it's a good question. So there's all sorts of reasons why, one of our counterparties would decide they need to approach a buyer like Pomona and sell an asset or a portfolio of assets. You know, like I said, a couple minutes ago, 15 years ago, usually it was because of distress. The seller needed cash, maybe, they were going bankrupt, the investor was going bankrupt and they had to sell private equity assets, to meet some kind of an obligation, whatever it was, it was often distress. But that's not really the case anymore. That still happens, but it's a smaller part of the reason why sellers actually sell. Starting with LPs, like investors in these funds, a lot of times it's just active portfolio management. Maybe they take a view that a general partner that they're investing with just, doesn't have a good competitive advantage anymore, and they don't want to re-up with their new funds. If Bain Capital or Hellman and Friedman raises a new fund, maybe they say, look, I don't want to give them more money for the next fund. And so to simplify my job so I don't have to keep up with all the prior funds that I already own, that I already, I'm invested in, I'll sell all those commitments too. And I'll just focus on a new manager that I like. I'll look at Genstar, or I'll focus on KKR, or whatever their decision is. That's often a good reason to get a little bit more active and clean up your prior commitments. Sometimes they need to rebalance just because their portfolio outperformed. So like I said, that happened a lot last year and early this year. You had pensions, endowments. We've seen insurance companies as well. Insurance companies have very strict requirements over what percentage of their investable portfolio can be in private assets. And when you get above that percentage, you have to very quickly fix that issue. Sometimes it's as simple as a pension hires a new CFO, and the CFO just wants to make their mark. Sounds crazy, right? But they just come in and they say, look, I have a portfolio that has 30 private equity managers in it. I'm going to keep 20 of them, and I like these other 10 better. So I'm going to sell 10 old ones and add in 10 that I like. So, there's a lot of both economic and non-economic reasons why an LP would go down the route of selling. A GP, so the general partner or the manager of these funds, they have a number of reasons as well. A classic example is a GP has a private equity fund, that's 12 years old with 3 or 4 assets left, and their investors are telling them, you got to wrap up the fund and give our money back. And instead of doing a fire sale to get rid of those assets at cheaper prices than I think they're worth, they get secondary buyers to come in and provide capital to basically buy out the old LPs, the old investors, and extend the time horizon on that fund. So that's a really useful tool for general partners. Another example, GPs today, let's say they had an asset that just knocked it out of the park. They're sitting at 5 times their money after 3 years, and they think it's prudent to, provide liquidity on that investment back to their limited partners to sell. But they think that company is still performing well, and if they could, they'd love to hold on to it for another 3 or 4 years, but they just understand it's in their LP's interest to get money today. So what they can do is they can go to a buyer like us, and we can come in, provide capital again for them to basically move that asset. This is that continuation fund idea, move the asset from their fund, into an SPV that they still manage. So they can kind of capitalize on the upside with additional carried interest for the fund. But it's a different actual investor, underlying investor. It would be the secondary buyer going forward instead of the original limited partners in the fund. So lots of reasons for all the participants in this market to engage. How do we keep our finger on the pulse? It's pretty simple, really. We try to talk to as many general partners, managers of funds as we can, as often as we can. And we try to talk to larger LPs as often as we can, because you never know when one of them is going to have a reason to do a sale. And if you find out about it first, you can kind of get a head start, and sometimes maybe a proprietary look at something. And then beyond that, we have, it's called a wish list. So we actually model out about 125 funds every single quarter. So we're looking at Bain's 10th, 11th, and 12th funds every single quarter. We're looking at Hellman and Friedman's, 8th and 9th fund. We're looking at Insight Partners 10th and 11th fund. We're actually updating our model on all the companies that are in all of those funds every single quarter, so that when we see something that looks interesting, or when someone approaches us and says, hey, we're thinking about selling our commitment to Bain, we can very quickly, within a day or two, turn around and get them a bid. So it's a great tool for us, really, to keep our finger on the pulse.
Yeah, that's great. So Alex, it's fair to say that more often than not, people are selling interests in funds for personal reasons than for issues associated with the fund itself.
Yeah, that's exactly right. And that's been an educational process, I think, for investors in secondaries funds over time to really help people understand that we're not looking to buy bad assets, right? We don't want to buy underperforming companies. We're looking to buy performing companies, great assets managed by great general partners, from investors who have some kind of an issue, liquidity issue or a non-economic, reason for selling. We're more than happy to provide you liquidity and take your place as an LP in a fund where we think the assets have a lot of room to grow.
Very helpful. Let's move on a little bit to the discipline that's associated with selecting managers. And I know, we're not necessarily here today to talk about specifically how Pomona does it, but I think using Pomona as an example, what are some of the things that a successful private equity manager looks for when evaluating a potential opportunity?
Yeah, sure. So, and that's one of the interesting parts about this market, right? Is PE is the highest performing asset class over time, but there's a wide dispersion, right? A top quartile PE manager is going to have 20% plus IRRs, and a fourth quartile will lose money. So you really have to be careful about both the managers you invest with and the actual assets as a secondary buyer, that we target to buy. So, in terms of the managers themselves, we're focused on stable teams, managers that have been doing this for decades. We're looking for, long-term track records. We're not often buying into a fund one. We're often looking at managers who are on their 8th, 9th, 10th fund and have, 10 funds of track record. We're looking at all their deal flow. When we look at that track record, a manager could have delivered 20% IRRs over the past decade, but is that skewed by one or two deals that were a home run and then they lost a lot of money on other deals? We like to see consistency. So, that all gets to kind of a loss ratio issue as well, right? We don't want big winners and big losers. We want consistent, strong returns across their investments. We also like to, in terms of our specific, when you're looking at a deal, a lot of managers in the space are restrictive about who they'll transfer to. So you'll see on this page, right, New Mountain Capital, that's NMC, CVC Capital Partners, TPG, they're restrictive. You can't, not just anyone can go in and buy a fund from one of their LPs and become an investor of theirs. They're very selective about who they'll actually let become one of their investors. And, given our long history in the market, our deep relationships with all these GPs, we get access and are allowed to bid on these transactions when they come up. So, we love to look for situations where, there may only be 3 to 5 buyers that can even buy a portfolio because there's so many restrictive managers in there. In terms of, the underlying assets, we marry that top-down approach, like I said, about, the qualitative information and quantitative about the manager and about, how restrictive they are and how invested the fund is. We marry that with a really quantitative underlying kind of bottoms up look at the actual companies. We're modeling every company in every fund in every deal we look at. So we're looking for companies that are growing top line, that are expanding their margins and becoming more profitable, companies with strong free cash flow generation that can support the debt load on those businesses, and most importantly, businesses that are valued reasonably, where we think that there's upside to that valuation and not material downside. And we use all that information to try to come to a potential band of outcomes for a transaction. What we're looking at upside scenarios, downside scenarios. The more narrow that band is, the better we understand the risk is how it, kind of shakes out. And we want to look for situations where, the upside potential is much greater than the downside.
Yeah, you mentioned something that I think is very important. We actually have a fund in the market now that is a 40 Act and a 33 Act vehicle for accredited investors. And that fund today has well over 1,600 underlying companies in that portfolio. And each one of those 1,600 companies has been underwritten by somebody at, or a team at Pomona. We don't take anybody's word for valuation. We don't take anybody's word for pricing. We do our work, and we base our business model on our ability to do good due diligence and good underwriting work. But Alex, to wrap up our segment on sourcing, how has Pomona's sourcing changed, if at all, over the last 5 years to adapt to the ever-changing market? And how do you expect Pomona's sourcing strategy to change over, let's say, call it the next 5 years, if at all?
Yeah, it's a good question. The short answer is not much. Hasn't changed much, won't change much. I think what we're looking for and how we're looking for it has stayed the same, and it will stay the same. We're not going to change our strategy tomorrow, just like we haven't changed our strategy, in decades, and because it works. What changes is that we're willing to get creative and buy those, target assets we're looking for and the target deal flow. We're willing to get creative and buy them in different ways. So, and how that impacts our sourcing is, we're willing to get a little bit, creative around structure with LPs, for example, or with the GP. Maybe we structure a preferred equity transaction where we have a lot of downside protection, but we still participate in the upside. But at the end of the day, we're not trying to change the profile of what we're buying, just maybe kind of how we buy it.
Good. Interesting. So let's turn to the underwriting and due diligence process, which we've alluded to a few times, and probably really is the secret sauce in what any secondary manager is using to create good performance. And using Pomona Capital as a reference, walk us through our due diligence process once we have sourced a potential opportunity.
Yeah, sure thing. So you can go to the next slide here, Bob. So yeah, perfect. So kind of three main points here, right? We're trying to focus on mitigating risk. And how do we do that? We look for downside protection. We buy in at discounts to their current NAVs. And, we really rely on our underlying analysis. And then, if we think we've made a return, we can actively manage our portfolio and sell stuff. So, we're looking to mitigate risk in those ways. We're focused on near-term liquidity. It's much easier to predict when a company will sell and how much it will sell for if we think it's going to happen in the next year. If we think it's going to happen 5 years from now, the world can look completely different in 5 years. Bugs Bunny could be the president of the United States for all we know in 5 years, let alone how am I supposed to tell you what, company XYZ is worth. So the closer in, the nearer term the liquidity, the more conviction we can get that it'll actually happen and that we understand the magnitude of the valuation that it'll happen at. And then, we're looking to stay very disciplined, right? With pricing, we want to make deals happen. We don't necessarily just want to react to what's available. And in terms of our actual, DD process, how that boils down is that, we're tracking these assets over a long time. We understand the assets well. We know how they've performed. We know how the managers that own them have performed. When we source a transaction, it goes through our pipeline committee. Just given how active our pipeline is right now, and like I said towards the beginning, we really need to narrow down our focus on opportunities where we have an edge. So we talk to our pipeline committee, set the goals for each coming week, staff that out to the team, and then we're looking to get as much info as we can. We have info because we've tracked these assets. We're also going to talk to the owners, the general partners, the managers of those assets, company management teams, public market analysts, industry experts, anything we can find to try to get us a little bit more information about how these businesses or the industries that they're operating in are performing. We have multiple investment committee meetings on every deal. And like I said, we're trying to come up with a band of outcomes with potential upside and downside scenarios. And that's how we price a transaction, to ultimately fit within our return, the return profile with the risk profile that we're hoping to stay within for our funds. So that's kind of the high level of how it works.
Yeah. So just expanding on that just a little bit, what are some of the key due diligence points, I guess, that you focus on in determining or examining a potential transaction? In other words, what are you looking for when you're evaluating an opportunity?
Yeah. So it's a good question. So I've kind of mentioned it. There's this top-down approach where we're looking at the fund level. That's where we think about things like the quality of the manager, where we think about things like the waterfall of the fund. So every fund, has a waterfall where that determines, when proceeds are generated, when the manager sells assets, does the proceed go to the limited partners, or do they go carried interest to the general partner? So we marry all that top-down analysis with our bottoms-up, LBO modeling capability. Our analysis always starts really with diligence on the companies. If the companies aren't growing, if they're not quality industry leaders, if they're not, valued reasonably, then there's no reason to even, move on to the next step. Just because, it all comes down to, at the end of the day, we make money if the companies perform well. We're looking for things, near-term catalyst events. Is a manager going to sell a company in 6 months or a year, and at what value? One thing to keep in mind is that private equity assets generally are valued only 4 times per year. So at the end of every quarter, the manager of the fund releases valuations. And in the secondaries market, when we buy into these assets, what it means is we're buying in off of stale valuations. So, today, right, it's October, end of October, we're still buying off of the value of these assets as they were marked at June 30th, 2021 in most instances. So we have the benefit of having, 3-4 months by the time that we're looking at a deal compared to where they were marked back then. So anything that's happened since then, we can bake that into our underwriting and make it that much more precise. Bob, I think you can probably change the slide. So, there's a lot that goes into it, like I've said, and here's how it kind of plays out in terms of our specific performance, right? You can see we've been able to find companies that have grown revenues, over 20%, EBITDA growth even higher. The companies that we're buying in are 3+ turns valued below comps, and lower leverage than comps, which means in a downturn, we'll have lower loss ratios. And that near-term liquidity you can see is the final bullet down there. So having that kind of systematic approach, marrying the top down with the bottoms up, the end result and what we've been able to compile in our portfolio has been quite impressive.
Yeah, no, that's great. And again, I think before we move on to portfolio construction and some of the key things that we look for in building a private equity portfolio, I know how important a robust financial model is to the success of any secondary fund. It's probably impossible for us to, given the time that we have today, to get through a full model, but can you provide a high-level overview of a typical model and its importance to our core value proposition?
Yeah, absolutely. And you're right. When we hire new associates, it takes weeks, if not months, to for them to get up to speed in our models. This is kind of a high-level example. This shows a fund, and so each row in the middle of the page there is a different company, and we've got metrics on the current valuation of the company towards the left side of that screenshot, and then in the middle, that's our projection of an ultimate value for that company and when it's going to exit. So each column there in the middle is a different time period, like a different year. So basically, what we're doing is we're looking at the companies, we're understanding how they're valued, which is on the left. Every one of those numbers in the middle of the page, that's a cash flow for that company, and that links to a different model for that specific company, a different LBO model where we, we'll look at revenues, we'll do revenue breakouts, we look at EBITDA margins, things like CapEx, interest rates that they're paying on their debt. We look at, net working capital, how much cash flow is available for debt pay down each year, a pretty complex kind of financial model to project out how do we think these businesses are going to do and when are they going to sell and what will they be worth when they sell. That's what kind of flows through into the middle of that model. Off to the right is more qualitative information. What does this company do? What industry does it operate in? Stuff like that. And then at the bottom, that's really where the returns kind of spit out. So once we have an exit associated with every company row, at the bottom, that's where we layer in the fees that that we're going to have to pay to the manager of the fund. We layer in the carry that the manager of the fund is going to earn. So we get to this net cash flow strip, which you can see at the bottom of the page. And that's where we then price our deal. We see that cash flow strip and we say, basically, what price do we solve to get to a return that's mid-teens or better, that we're comfortable with in our fund. So, that's kind of the high level. It gets much more in depth from there, but basically every fund that we buy has a model like this. All the companies in that fund have their own separate model that links to this. And if we're looking at a portfolio with 10 or 15 funds, then we have 10 to 15, however many funds it is, of these fund models with all those other company models, underlying in those as well. So they get to be pretty complex, large Excel files.
Yeah. So it's fair to say, that the fund I alluded to, the 40 Act vehicle that we have today has, like I mentioned, over 1,600 companies. Each one of those companies has a line in one of the models that Alex is talking about. So, a tremendous amount of, and I would encourage you, if you're looking at any secondary fund in the private equity space, to make sure that the depth and breadth of what they do is similar to what Alex just described. And Alex, I'll just end our segment with, we talked a little bit about sourcing and how that might have changed. Has our due diligence process changed or evolved over time? And what are some of the noteworthy lessons that we might have learned?
Yeah, we're always looking to get better, right? If you're not looking to learn from things that didn't go like you thought they would, you're not trying to improve your process, then what right do you have to get third-party capital to invest? So things that we've learned over the, we're trying to basically incorporate as much data as we can, both from external sources, but also things that we've learned from our deal flow into our analysis. One thing that we learned, for example, historically Pomona has had some exposure to energy, not a large amount, but some exposure to energy. We thought it made sense in the broad scheme of a wider portfolio. And we've learned over time, energy investments, especially oil and gas investments, can work out great, or they can work out horribly. And you're really at the whim of commodity prices. How much oil does OPEC want to pump out of the ground, next month or next year? These are just like large external risks that how do you quantify that? You really can't. And those are assets that you could lose all your money if you're not careful. So we avoid energy today. We avoid FX risk, for example. We have the ability to hedge in certain ways, euros, pounds, some currencies, which we'll do whenever necessary. But a currency that we can't hedge, let's say there's a fund that comes up in the market that's an Asian fund that has exposure to, the Thai baht. Can't hedge that. How do you, or the Brazilian real, if we can't hedge it, and we also, can't control what's going to happen with the fiscal policy of Thailand or Brazil. It's just a risk that you can't quantify. So we avoid FX risk whenever we can. We avoid political risk whenever we can. For example, we don't have much Asian exposure in general, similar with kind of Latin American exposure. Tomorrow, you could wake up and see a headline that the Chinese government has made something illegal, and then this company that you thought was the best company in the world is worthless. And it's just risks like that we stick away from. Those are kind of lessons that we've learned over the years, that there are risks that you learn about them that you just can't quantify.
Yep.
Yeah.
Yep. Thanks, Alex. That was great. I want to spend the remaining time talking a little bit about portfolio construction. Heard a lot about the sort of the raw ingredients that could go into a decision, and I want to turn it over to Adam now. And Adam, we've noticed over the past few years that a greater number of private equity managers, GPs, if you will, are looking to make the asset class more accessible to individual investors. Given that we have some experience in this space, can you talk about why that is, how these specific vehicles are structured, and how this particular structure differs from the standard limited partnership that has been commonplace in the private equity industry for many years?
Yeah, happy to do that, Bob. But first, thanks for having me here today. Happy to pick up where Alex left off and spend a little bit of time talking about our experience in serving the individual investor slash mass affluent part of the market, which is something that we've been doing now with Pomona Investment Fund that Bob alluded to earlier since 2015. So while PIF or Pomona Investment Fund, or PIF as we call it, was certainly, one of the early movers in this space. You are now starting to see, more and more products from a variety of managers attempting to enter the space in some way, shape, or form. And I think a big part of that has to do with the fact that when you look at the history of the private equity industry, you'll find that, the vast majority of the capital has been raised from institutional investors, right? So that's pension funds, endowments, foundations, sovereign wealth funds, et cetera. And a very small portion has come from individuals, right? So you have this entire part of the market that has historically been unserved by the private equity industry, and this isn't really a small niche part of the market either. Now there's a lot of different ways that you can quantify this, but however you slice it, we're talking about tens of trillions of dollars here, right? Tens of trillions of dollars of investable assets that are held by these investors that really haven't had the opportunity to invest in private equity. So you have this massive opportunity set for these private equity managers that really has the potential to be quite a significant catalyst for growth. And I think that's why we are seeing so many folks or so many new players enter the space here. Now, there's certainly challenges that come with bringing private equity to the masses. And Bob has certainly alluded to this a bit earlier, but a lot of those challenges have to do with the typical private equity structure, right? It's just not built for individuals. It's built for large scale institutions, right? So typically private equity funds are limited partnerships with a 10+ year life. They call capital from investors on an as needed basis. Investors typically have no redemption rights, or they can't get out of their investment. And instead they'll receive capital back in the form of distributions as the underlying companies are sold or other liquidity events occur in the portfolio. So there's a lot of operational work that goes into holding an investment like this that quite frankly can be burdensome for individuals. So Bob, if you don't mind just switching to the next slide now. What we've done, and now some others have done as well, is we've taken that same private equity focused investment strategy, and in the case of PIF, it's a secondary focused private equity strategy, and we've put that into a structure that removes some of, if not all, of these operational burdens. So this ends up operating kind of much more like a mutual fund than a limited partnership private equity fund. So what does that mean exactly? Well, it's continuously offered. So there's no capital calls. We're out there raising capital every single quarter, and investors, fully fund their investment on day one. There's also a quarterly tender offer process that's subject to board approval, but we can provide liquidity to our investor base should they need it. On the tax side, it's a 1099 product, so investors don't have to deal with K-1s and the delayed tax reporting that comes with that. And then lastly, it's available on a number of the major custodial platforms out there, such as Schwab, Fidelity, TD Ameritrade, Pershing, and others. So again, the idea here is really to provide the mass affluent with access to institutional quality private equity in a structure that is familiar to them and much easier for them to use than a typical limited partnership private equity fund. And I think we've been able to do that here with Pomona Investment Fund.
So that's great. When we think about putting together a portfolio, how important is manager selection in private equity versus, say, some traditional asset classes?
Yeah, so Alex actually touched on this a little bit when he was talking about our process, but manager selection is very important when you're talking about investing in private equity. If you look at the performance of the best performing private equity managers that are out there, we're talking about the top 5%, top 10%, 25%. Their returns are far greater than those on the bottom end of the spectrum, right? So the bottom 5 and 25%, et cetera. And to be a bit more specific here, we're talking about a difference that is, in the thousands of basis points of annualized returns, right? And this dynamic is very different in other asset classes, which I think is what you can see on the slide here, where, in other asset classes, the best performing managers outperform the worst performing managers by only a few hundred basis points and even less in some instances. And I think, a big reason behind that is the fact that, one of the things that I don't think people really fully appreciate about private equity is that it's very high touch, hands-on approach that's required in the buyout space in order to generate outsized returns. What I mean by that is private equity managers have to do a lot in order to extract value from a portfolio company. For the most part, these firms don't just acquire a minority stake in a business because they believe it's undervalued or that it's going to grow. These firms are actually taking control of these businesses, and they have a clear plan as to how they're going to grow the business and extract value, right? So are they going to bring in a new management team? Are they going to expand into new territories? Are they going to cut costs? Are they going to implement some form of a M&A strategy? So, I think if you're a manager that has a process, that has knowledge and expertise, of a particular industry, and has experience through, working through kind of multiple economic cycles, you have the ability to really generate these outsized returns and reap the rewards that come with that. But on the flip side, if you don't, I think the outcome will be far less impressive. And I think that's exactly what you're seeing here with returns like this that are so dispersed, really across the entire private equity universe.
Yeah. In looking at this, you kind of have to feel bad for some of our fixed income friends and and even some of our public equity friends, where the difference between first and fourth quintile can be rather slim versus private equity, which is rather wide, as you described.
Exactly.
I suspect that in addition to investment management, cash management might be a close second when it comes to managing a successful, continuously offered fund or vehicle. Can you comment on how you see the role of cash in the portfolio and how Pomona's 40 Act vehicle manages to that cash?
Yeah, happy to do that. So, you're absolutely right. Cash management in a vehicle like this is certainly of the utmost importance. One of the structural differences that I talked about just a little while ago was that there's no capital calls, right? So instead, investors are fully funding their investment into Pomona Investment Fund or into whatever vehicle we're talking about here on day one. So, these products are not afforded the luxury of being able to call capital on an as-needed basis. So, because of that, we're constantly monitoring the fund's cash position to make sure that on one hand, we have enough capital available in order to meet, all of the fund's financial obligations. But on the other hand, we're not holding too much cash so that we're dragging down the returns of the fund. And the way that we've kind of gone about doing that, and that I'm sure others in this space have as well, is you constantly have to look at all the cash flow coming into and out of the fund and kind of project, what we think that's going to look like in the future, really to make sure that remain balanced, right? And these cash flows can come in a variety of different forms, and depending on what part of the analysis you're looking at, there can be quite a significant amount of estimation that goes into it. And because of that, this analysis is something that we're constantly updating, so we can more accurately project how much cash we will have available to invest at the end of a given quarter, which is typically when we close on new secondary investment transactions. And just to get a bit more granular here, when you're looking at these different inflows and outflows that exist in a fund like this, I'd say the greatest amount of estimation is around new subscription activity, distributions that are received from the underlying funds, as well as capital calls that we pay to the underlying funds. And on the flip side, I'd say the fund's expenses and tender offers are easiest to project. Tender offers are very interesting, in that the process that's in place really provides us with about 4.5 to 5 months of advance notice before we have to make any tender offer payments. So we have plenty of time to plan accordingly and make sure that we have the liquidity available to make any tender offer payments. And the last point that I'll make here that I think is really important for us from a liquidity management perspective is the credit facility. This is something that we implemented back in 2018 and allows us to more efficiently manage our cash position. It's mostly undrawn and effectively serves as an insurance policy for us that provides the fund with additional liquidity in the event there are any unforeseen macroeconomic events that cause other sources of liquidity to dry up. So in other words, it really allows us to draw down our cash position lower, given that there's this liquidity available to us under the facility in the event that we need it. But just to kind of conclude here, you're absolutely right. This is a very important part of what we do. And it's something that we at Pomona place a great deal of emphasis on in order to make sure that we get it right.
Yeah, Adam, that's great stuff. And I think our audience might benefit or appreciate some real life examples of some deals that have been done over the past year or so. For example, Alex talked a bit about the restricted nature of working with a general partner. That could be one example. And then, we at Pomona, when we see a deal that we like, how we go about cherry picking the actual funds that we want to own.
Yeah, sure. I'm happy to jump in and do that. And you're right, Alex touched on this a little bit, but the first deal that we're going to talk about here is one where Pomona acquired interests in 17 underlying funds, covering a variety of vintages, investment strategies, geographies. So certainly a very diversified portfolio. In this particular instance, there was actually over 75 underlying companies, and none of which made up a significant portion of the NAV that we acquired. But the story here, that, and as Bob alluded to, is really around the GP mix and the restrictive nature of these sponsors. And Alex talked about this a bit earlier on, but in every secondary deal, each underlying fund manager needs to approve the transfer of an interest in their particular fund or funds. So what that means is if I'm buying an interest in, let's say I'm buying an interest in a Blackstone fund from Alex, and me and Alex can agree on a price, we can agree on terms, we can think we have a deal in place, and then Alex goes to Blackstone and says, hey, I want to sell my interest in Fund 5 to Adam, and Blackstone says, I have no idea who Adam is. I'm sorry, I'm not approving him as a buyer. So Pomona tries to be, a party that has very strong relationships with each GP to ensure that those types of situations don't happen to us. And that instead we can be the benefit of, put ourselves in situations where we are, only one of a small number of approved buyers to buy a particular portfolio. But in this particular instance, that was exactly the case, right? Pomona there were only a limited number of potential buyers out there who were approved for all of the underlying funds in the deal. So this makes us, and made us in this instance, a much more attractive buyer to the seller, right? Because we can now provide them with a complete liquidity solution. And from our perspective, it also limits the competition, right? It makes it much more likely that we can win the deal at pricing levels that are acceptable to us. And that's exactly what we were able to do here. So, I think we've all talked about this a little bit throughout the presentation today, but the secondary business is very relationship intensive. And we certainly try to leverage those relationships as we're sourcing, underwriting and closing transactions. And I think this one in particular is a really good example of that. And then kind of moving on, Bob, the next slide goes through a different deal here that I think we're going to talk about that is more kind of in the line of cherry picking that you alluded to. Yeah, there you go. So this is another secondary transaction where Pomona acquired an interest in a KKR fund, KKR America's Fund 12. We've been introduced to the seller who was looking to sell, a larger portfolio of about 5 underlying funds, but we had identified this one in particular that we wanted to pursue more aggressively. And this is something that we do quite often. And, I think we even talked about this a bit earlier. We know what we want to own, and we try to do whatever we can to own those assets, right? So that obviously kind of begs the question, well, what do we like about this one that made us want to cherry pick this fund out of a larger portfolio? Well, for starters, we've worked with KKR quite extensively on both the primary and the secondary side of things. And we're actually going through our diligence process for a primary commitment to their latest fund. And we're able to leverage the information that we obtained through that process in order to sharpen our pencils on the underwriting for this particular secondary deal. So we felt we had, a really good understanding of what was going on inside the portfolio, which allows us to more accurately underwrite the fund. And the other point here that I think certainly one that's important is has to do with timing. When you look at this fund, it's a 2017 vintage fund, so it's about 4 years into its life, and that means it's at a point where it's kind of approaching an inflection point in its life, right? It's just about wrapping up its investment period, and we believe should soon start to liquidate, some of the underlying companies in the not so distant future. And these liquidity events typically provide opportunities for growth, right? And based on our underwriting, we believed at the time and still believe that there are quite a few opportunities within the portfolio for these types of events to occur. And just one in particular, the largest asset in this particular fund actually IPO'd between record date, which is the date as of which we're actually pricing the deal, and the time that we actually closed the transaction. So we were able, and we kind of had some clear insight as to into the fact that that was going to be coming. So we were able to factor that in and kind of reap the benefits of that IPO event, given that it occurred again subsequent to record date. So we really try to put together a portfolio of choice, and that certainly requires us to be, selective about the assets we buy. And I think this is a good example of that. It shows that we really focus on buying the assets that we want to own. And this is certainly one that has performed well for us to date, and we think will continue to perform well for us in the future.
Great. So Adam, my final question for you before we take a few questions, and there are a few that are in queue from our audience. I think adding ballast to a well-constructed portfolio should be a primary goal for most investors. And, obviously we think private equity is one way to create that ballast. How have private equity secondaries performed in sideways and downward public equity markets?
Happy to do that. Right. So if you kind of, I think what we've seen fairly consistently throughout the history of private equity, and more importantly, the secondary market, is that these asset classes really tend to outperform broader public markets in times of greater public market volatility. And what we've shown here on the slide, by taking the 8 worst drawdowns in the S&P 500 over the past 20 years, and we've compared the performance of the S&P during each of these periods to primary private equity, as well as secondary private equity. And we've done that using two Cambridge indices. And as you can see, the results are that secondaries have outperformed each of these, or kind of both asset classes in each one of these periods. And I think part of this has to do with the point I talked about earlier, where private equity managers, particularly buyout-focused private equity managers, typically own controlling stakes in each of their portfolio companies, and they have a lot more freedom to impact the business and adjust course if the market in which they operate, are experiencing some form of macro headwinds, right? So they can change course much easier than a public equity manager who just has a passive stake in a public company. The other factor at play here, is that the secondary market and secondary investors in general are typically able to purchase assets at a discount to net asset value, right? And those discounts typically widen in times of macroeconomic distress. And Alex alluded to this a bit earlier when he talked about some of the deals that we were able to get done, last year. And these discounts are something that we fully earn at purchase, which offsets losses that may be incurred elsewhere in their portfolio. So they certainly provide some protection on the downside. With that said, I think kind of the next obvious question is exactly kind of the next slide there. Thanks, Bob. The next obvious question is, what does this mean for overall performance? Well, fairly simple math says if you outperform on the downside, you have a much smaller hole to dig yourself out of, right? And if you're able to keep up with most of the upside, maybe not all of it, but most of it, you should outperform over longer term time horizons. And that's exactly what's happened here, right? Better returns with less risk. So kind of this dynamic fits really nicely into our portfolio. And I think if you kind of look at how secondaries would perform in a larger portfolio with some public equity exposure, some fixed income, some additional private equity exposure, it works quite well together. And I think this dynamic certainly adds to that, I think, a little bit.
Great. So thank you, Adam. And I know we've got a couple of questions in queue. I also know we're at the top of the hour. So what we're going to do is we're going to take a couple of those questions, and then we will be sure to get back to you. For those questions that we don't get to, we will be sure to get back to you following the presentation today. So the first question actually dovetails quite nicely, Adam, with what you were talking about. Be curious, Alex, your view on this as well. With so many assets flowing into private equity, are discounts going away? And if so, do you see private equity performance coming down as well? So maybe we'll start with Alex and then move on to Adam.
Yeah, so the answer is no, short answer. Discounts certainly are a key part of what we do. That the goal, and like I was saying earlier, right, we're looking for situations where we have a sourcing edge. And so there's a number of reasons why we can get a discount on a good asset. whether it's because the GP is restrictive, like we were talking about a few times in the presentation, maybe it's because, the valuation is quite stale. So we know that a company has sold at a big gain between the valuation date that we're looking at and the when we're actually bidding on the assets. And so basically we're kind of taking advantage of multiple, a bunch of different data points that when we bake it all together, we're able to find situations where we can get these discounts. So, our in terms of our institutional funds, our ninth fund, which was closed in 2018, that fund average discount is in the mid to high teens. The fund before that, our eighth fund, which was the 2014 vintage fund, that average discount I think is about 14%. Adam, I'm not sure if you have the answer on PIFs.
Yeah, PIF's average discount since inception. So since 2015 is about 18%.
Yeah, exactly. So it's been very consistent in terms of the discount we've been able to get. And it really just comes down to being creative with that sourcing.
Yeah, I think Alex hit the nail on the head. I think we try to pick our spots, right? We try to be very careful with kind of how we attack the market. And I think that allows us to kind of, find assets with better than market pricing. But I think just in general, I don't think discounts are going away. I think they obviously move with, markets evolve over time, and there's obviously different points in time when discounts are larger than others, but they're certainly not going away.
Great. And our last question before we conclude is actually a two-part question. So I'll throw it out to both you guys. How do you best benchmark private equity? Is it to the public markets? Are there any industry benchmarks that we can use? And the second part of this question is, when is the best time to invest in secondaries? So two loaded questions. Maybe we'll start with Adam.
Yeah, so I think benchmarking is an interesting one. I think we've as we talked about here today, if you look in our presentation, right, we've used Cambridge, but there's other folks out there that kind of are data, kind of aggregate data across private equity funds that I think you can use to benchmark private equity. Preqin is one, but I'd say Cambridge and Preqin. PitchBook also has a bunch of data as well. Those three I'd probably say are the most commonly used. And I think but I think there's and they all have their pros and cons. And then I'm sorry, what was the second part of that question, Bob?
The second part was, and this is somewhat rhetorical, but when's the best time to invest in secondaries?
Yeah, I think now, quite frankly, I think it's always a good time to invest in secondaries. I think one of the things that's really nice about secondaries is two things. Just in high level stuff, right? The portfolios that we put together tend to be very diversified. Right, Bob talked about PIF earlier, right? We have 1,600 underlying companies in that fund. We have exposure to over 200 underlying funds through relationships with over 100 different private equity sponsors, right? So and it's diversified across strategy, it's diversified across vintage year, it's sector, et cetera. So a very diversified pool of high quality private equity assets. And I think the other part of kind of what we do that really stands out and makes it even more interesting is, and Alex talked about this, is really kind of making sure that we partner with best in class sponsors, right? We're investing, if you look at kind of the GPs that we're investing with, it's a who's who of private equity managers, right? It's the best in the business. And I think if you focus on quality and you have a diversified portfolio and you have a team like Pomona, who's been doing this now for 27 years, I think your likelihood of achieving success is far greater than some of the other folks that are out there. So I will turn it over to Alex to see if he's got anything else.
No, I think that's right. I think it's just, it sounds self-serving and crazy, but, the kind of nature of the asset class with the diversification and the fact that we're buying in at discounts for our new deal flow. And, PIF in particular is a evergreen product, which reinvests, liquidity that we get back. So just from the nature of that, we're protected a bit on the downside. There's a buffer on the downside, and then, but we still get to capitalize on the upside. So when things are bad, we won't go down. Historically, we haven't gone down as much as the market. And on the upside, when things are good, we tend to, be able to capitalize and keep up with, how things are doing on the upside. So, we generally think it's kind of a fool's game to try to time things. We like to look at deal flow in terms of how do we buy into something that has the best chance of success and gives us some kind of a margin of safety and some downside protection. That's how we built the portfolio and how it's performed. So, whether you buy in today, where arguably maybe things are a little bit overheated, or you buy in to the fund, in April of 2020 when things are maybe a bit, on the bottom, your performance should be pretty consistent over time.
Yeah, thanks, Alex, and thank you both, Alex and Adam, for a really good, I think, high-level overview of how a private equity secondary fund works. I hope we were able to answer any questions which you might have had, but in the event you would like to speak further about anything that you've heard today, or if you're looking for the best way to access the secondary market, please do not hesitate to reach out to a member of our team. You can see the phone numbers and the website, our website, and our email address. But reach us at 855-211-3220. Or again, as I said, take a look at our website, which I think you'll find has some useful information. Again, I want to thank you for joining us today. We appreciate your ongoing interest in private equity and the secondary market. All the best, stay safe, and have a great rest of the day. And on that, I'll turn it back over to you, Charlie.
Thank you so much, Bob, Adam, and Alex. And thank you to everyone who connected with us today. You should expect to see an event survey in your email inbox following this meeting. And that survey will include a replay as well as the meeting presentation that was used today. So again, thank you everyone for your time and have a great rest of your day.